This is a take from Greg Peters of PGIM Fixed Income. This is what he's got to say. The global economy will grow at the same rate as in 2024. The US economy is doing quite well. The biggest risk is a resurgence of inflation. If inflation rises, we could return to the environment of 2022. You'll recall, of course, that 2022 was bad for both stocks and for bonds. Greg joins us now for more. Greg, let's talk about that big risk, and welcome to the programme, and of course a Happy New Year. What underpins that risk for you? Where would that resurgence of inflation come from?
Yeah, so I mean, it's not a base case, by the way, Jonathan, but it is a risk, though. And so just, looking at the pace of inflation, it seems to have moderated for sure. You're seeing the housing market still showing signs of inflation. The labor market's still quite healthy. So the seeds are there. Am I expecting kind of resurgence like we saw, back in 2022? Not necessarily, but the fact remains the market has really leaned into this disinflationary camp. So any movement away from that, I think, is a shock to the system.
Greg, given that, are you staying away from Tuesday's $39 billion of 10-year notes being auctioned off and the $22 billion of 30-year notes being sold on Wednesday?
Well, that's part of the self-fulfilling problem, right, Lisa? You have a tremendous amount of debt hitting the marketplace. The supply just keeps coming and coming. I think all else equal, that puts pressure on the curve, puts pressure on rates. And so you have that coupled with maybe inflation being a little more sticky or reversing, moving higher, that puts more pressure on the bond market. So, I think rates will be quite volatile and, if anything, a little higher than what people envision.
Greg, this seems like kind of a shift for you. You were more positive, more constructive on U.S. fixed income and even duration a couple of months ago. Am I right? What's changed?
Well, so I think some of the policy, items have changed. Our view all along has been a very wide, volatile range, which, professional fixed income manager doesn't like to have such a wide range. But I think that's the environment that we're in. We're spending so much time talking about policy. At the end of the day, we're investors, right? We look at fundamental data and we're being driven by these policy factors, which I think is, a much more difficult task. But we look at tariffs, we look at some other items, we look at the resiliency in the economy, and that probably points to more inflation, less Fed moves, and higher yields.
You're bearish on energy, and I have to ask, this is a priority for the incoming administration when it comes to, quote, drill, baby, drill, but also deregulation, which should make it easier for energy companies to do well. Why so bearish on the sector?
Well, so I think it's more of a factor, like how much more capacity is there, right? So drill, baby, drill, there's not a lot more that they can do. And so if anything, what drives energy prices is the global economy, China as well. And so we look the supply side, moderating, but then the demand side coming down as well. So I think that's the driving force. And it's important to remember, this was a narrative back in 2016 as there was all this hype and excitement around the energy sector, and it was the worst performing sector. So, just be kind of a little skeptical, cynical around some of those policy initiatives and how it translates into sector performance.
Which sector do you think is going to benefit the most under the incoming administration?
It's hard to say. There's so many moving parts, of course, but one area that we continue to be focused on is the financial sector. Less regulation on the margin, is quite helpful, but fundamentals are really quite strong. And so, we think the, financial sector should continue to do quite well here.
Greg, I know it's not your base case, but if we did get a resurgence of inflation and a repeat of 22, and you, by the way, are not the only one who's raised the prospect of that. Torsten's Lock of Apollo wrote the same thing coming into 2025. What works? Where do you hide when stocks and bonds are both pretty dicey?
Yeah, nowhere. I mean, that's what makes it so scary, right? It's so challenging and inflationary environment. That's what we relearned in 2022. But what should do better is some of the commodity based as segments. But there is no real place to hide, which is why you're seeing gold being so resilient, right? That is an asset that investors, rightly or wrongly, like to hide in those types of environments. So, I think the playbook, if in fact that base case does come, that risk to the base case does come to fruition, there's not a lot of places to hide from that.